In this video, we'll look at the labor market dynamics when there's a change in the capital stock. Let's suppose there's a destruction of capital stock. For example, this could be the regional effects on a labor market when there are natural disasters such as hurricanes or forest fires. Let's set up the labor market. We have a downward sloping labor demand curve and an upward sloping labor supply curve. Let's label the horizontal axis the quantity of labor. Label the vertical axis with the wage, i.e. the price of labor. And let's label the original equilibrium, W1 for the original wage and L1 for the original quantity of labor. So what happens if there's a destruction of capital stock? Well, capital stock are buildings, machines, and equipment. With fewer of those things to be used in the production process, labor is less productive. That means there's going to be a decrease in labor demand, i.e. a leftward shift in the labor demand curve from our original labor demand curve that's blue, labeled LD1, to this leftward one that's red, LD2. Let's label the new equilibrium W2 and L2. We can see that there is a decrease in employment as a result and a decrease in wages. Similarly, let's look at what happens if there's an increase in capital stock. For example, from prior investment. Suppose in the last few years, businesses were optimistic and they expanded their facilities. With more buildings, machines, and equipment to use in the production process, labor is more productive. This leads to an increase in labor demand. Labor demand shifts to the right. And then in our equilibrium, we can see W increased, so there's an increase in wages, and L increased, so there's an increase in employment.